It's going to be a brutal summer. This is the damning conclusion from today's guest, Durrett. The gold stock analyst joins us today on Goldcore TV to discuss the global state of play and what this means for the US dollar. Spoiler alert, not good things. For Don, gold and silver prices were always set to climb and the dollar set to fall. And the likes of the pandemic in Ukraine may have helped this somewhat, but ultimately, all they've done is put further damage on an already badly damaged economy. Don explains to us the systemic risks and how the perception of these risks will ultimately see a collapse in US dominance and a rise in the power of Eurasia. One significant focus of this conversation, and it can't be overstated just how important this is the ongoing strategy and upcoming dominance of the BRIC countries and their desire for a new world currency. If you can take one thing away from this episode, then let it be about the significance of perception. This is something Don talks at length about, and it's such an important lesson when it comes to investments and markets. And if you enjoyed this interview, be sure to share it, to tweet it, and to hit the like button. And if you haven't already, why not subscribe to Goldcore TV? This is one of many brilliant interviews we have for you. And if there's ever a time to be getting as much insight as you can, it's now. Don Durrett, welcome to Goldcore TV.
Hey, Dave, first time on. Thanks for having me.
Pleasure to have you, sir. Now, I'm going to start with this question. Recently, I heard you say that the three big things that are going to drive the gold market higher are inflation, the war in Ukraine, and the COVID pandemic hangover. Now, we've got inflation at about 8.3% in the States. It's high globally in the UK, in Europe. We're even seeing inflation for the first time really in Japan as well. It's a major problem. It doesn't look like it's going away anytime soon. Ukraine, that's going on an awful lot longer than we expected. And the COVID pandemic, we're still having a hangover from that. Are you as confident or even more confident in these as three drivers that are going to drive the gold market higher?
Yeah. I'm actually more bullish as we get into this year. As we're, especially inflation. So the underlying driver for gold is always going to be uncertainty. I call it the fear trade. Mm-hmm. So as a gold investor, I don't care about short-term returns. I don't really care about, gold, like gold right now is like a little under 1850. I don't care about gold going to 1950, $100 move. That doesn't get me excited. What I want to see is all-time highs. As a matter of fact, I really want to see 2,500. I want to see gold to run to 2,500 and then keep going, go to 3,000. So I'm always looking at the drivers that are going to push it up to those levels. So in the short term, inflation, Ukraine, and COVID are definitely stuff to watch, of course. But the underlying one, the fear, uncertainty, and what that comes down to is systemic fear of the financial system. So I got into this, 20 years ago for that reason. So the U.S. economy, I look at this as the big picture. So if you look at the U.S. economy, it really peaked, I think, in the late 1990s. And since then, all we've been trying to do is just hang on. So our standard of living has been maintained through debt. And that can only go for so long. It's like a corporation living off a credit card. At a certain point, your creditors cut you off. And that's my expectation. So if we look at some of these factors, like COVID, for instance, so COVID is actually putting further damage on the U.S. economy. It was already damaged. So even without COVID, the Fed was manipulating, supporting the economy, creating growth through low interest rates, which really, we're growing. Why we have interest rates at zero didn't really make a lot of sense. He tried to raise it like in 2016 and he couldn't. Powell did when he first took over as chairman. He couldn't, and he had to take it back to zero. And so our economy was already weak going into COVID. And so COVID has created further damage. And I don't think we're going back to normal. So all of this, the reason I'm in gold and silver, the underlying reasons are getting more and more obvious to others that the U.S. economy has, is basically a lot weaker than is perceived. The underlying fundamentals of the U.S. economy are weaker. We don't generate enough wealth to, for instance, monetize our debt. So right now, once COVID hit, the Fed finally started to monetize the debt. If you look at the chart of foreign ownership of our debt, it's not rising nearly as fast as our debt. So foreigners are no longer, attracted to our debt. And I think it's probably going to, flatline or go down. It's probably going to go down. And at a certain point, these drivers, COVID, inflation, Ukraine, those drivers will morph into this fear uncertainty that I think will release precious metals much higher. Now, I don't think it's going to happen this summer. And there's another driver here, which is the dollar. The dollar, I didn't think the dollar would take off and go like above 100 because I thought that people would recognize the weakness of the U.S. economy. But it turns out that once the U.S. raised their rates, Europe did not raise them, and they're still at zero. Japan didn't raise theirs. So in the basket of the DXY, Europe and Japan are like 65%. And so the dollar went way, way up versus those two currencies. I didn't expect that. So the dollar is actually going to create headwinds here for gold through the summer. It went from 105 down to 101 today, but I think it's going to even go back higher because
it's a relative strength, isn't it, rather than an absolute strength?
Yes.
It's kind of like fiat currencies all losing their value, but other fiat currencies losing their value faster.
Yeah, and I think that it's misleading. The high dollar is misleading. It's not really reflecting the ultimate value of the U.S. economy or the ultimate strength of the U.S. economy. And I think that once the dollar does turn over, once the Fed does pivot, and I think they will have to because of their MMT strategy of injecting money, printing money, and keeping rates low, that inevitably the dollar will drop. And I expect it to crash myself very hard. My long-term outlook is very bearish for the dollar because of this. I think that once the Fed adopted MMT in 2007 and 8, that was kind of the end of the dollar. And I actually think that ultimately the U.S. will default on a percentage of its debt. I don't think it'll default 100%, but I think bondholders will have to take a haircut because the Fed won't be able to monetize it all without creating hyperinflation. And they will default on a portion of it, a percentage of it, say 35 to 50%. And when that happens, it'll be lights out for the U.S. economy as far as, growth, if you will, dynamism, strength, all that stuff. So I'm expecting this kind of be the U.S.'s lost decade, where Japan had their lost decade in the 90s, and we're turning Japanese. And so I think that's starting right now. I do not, for instance, S&P 500, it got to 4,800, and I don't think we're going back there this year. I think we're just going to muddle along. I think we're going lower from here too. 3,400 to 3,700 is my expectation. I think this is a dead cat bounce that we're seeing right now off of the bottom, the intermediate bottom, and now we're going to go lower is my expectations.
Sorry, I was going to say, so you see that the groundwork for a weaker dollar going forward has already been laid?
I think so, because of basically the main drivers here. Ukraine was the black swan. The Ukraine really upset the apple cart for the global financial system. So you have China. I think China and the U.S. were basically at war economically before COVID hit. And the Chinese are they're basically Japan on steroids. So Japan in the 1980s and late 70s were competing against the US for economic dominance. And if they wouldn't hit a wall at the end of the 80s, they might have kept growing. They were starting to dominate, and everybody was thinking, is Japan going to overtake the U.S., a small little country, right? 120 million people. They're going to take it. But China, they're just as ruthless in their aggressiveness of basically growing economically. If you look at what they're doing with the One Belt Road, with their investments in Africa, their investments in South America, they're trying to usurp the US's global dominance economically, and they're not holding back. And so that war was already taking place. And now they don't like the fact that the US currency is hindering them, and that we're exporting all these dollars and we're exporting inflation. They don't like that. They want the global reserve currency to be some type of a basket. And so now the Ukraine is basically pivoted China to basically take this currency war to another level. So you have the BRICS, and the Chinese just recently, they basically, one of their government employees or whatever said that they want to expand the BRICS into basically an economic group. Mm-hmm. So that economic group is not going to use SWIFT. Mm. They're going to use a new system, and that hurts the petrodollar and it hurts the euro dollar. And I think it's not going to happen overnight, but at a certain point, the U.S.'s global dominance is going to wane. And like I said, I'm expecting a default of some type on our debt, because we're going to be running $1 trillion deficits the rest of this decade. And once we go into a recession, which I think we might be in one right now, that deficit's going to go to 2 trillion. And that's 150 to 180 billion dollars a month. Wow. That's a lot of money that has to be monetized by the Fed if nobody else is buying it. I'm not expecting a crash in the U.S. economy. I'm expecting muddling. In other words, really, really flat growth. I'm not expecting a crash in the stock market either. 3,400 on is not a crash.
And sideways from there, is it?
Sideways, that's what I'm expecting, muddling in stagnation and just basically hitting a wall. Kind of what happened to Japan. They hit a wall. And Japan right now is in a recession. Japan right now, they're having no growth right now. They're worse off than the U.S. economy right now. So that, and it shows you MMT didn't work for them. It's not working for us.
And do you think then the war in Ukraine has brought all of these things to a head, basically, whereby particularly some of the actions of Western governments and Western central banks, where they have basically weaponized dollar assets, has been a further encouragement to China and Russia in particularly, but the BRIC economies wider than that, to actually accelerate this concept of moving away from a US dollar domination?
I think so. I call it the black swan event. And I've been basically, my analysis is that the US era is coming to an end. It's global dominance, both economically and militaristically. So it looks like the U.S., the dominance for the military is going to go forever. But I submit that once we lose our economic domination, we won't be able to fund it. So we're at like 800 billion a year in funding for our military. I think it's going to go down somewhere between 100 and 150 billion. I think it's going to crash that hard. And once it does, 5 years later, we'll no longer have military dominance. And that'll be the big shift, right? So and I think that'll happen, this decade, 5 to 10 years. I think you're going to see the military budget crash that hard, and it'll coincide with this default that I'm expecting. And it's basically an end of an era. And it's basically, if you've been watching it, paying attention since basically the 1990s. When it actually goes all the way back to the 80s when we started using debt to get our economic growth going. Instead of we moved away from mercantilism, which we used all the way through I would say the mid 70s, and we went to globalism. Once we went to globalism and debt, that was kind of the sign that the US was in trouble. You really need, I mean, you want to be a strong economy, you need to make stuff. You need to make enough stuff to generate wealth. That's the key. And we're not doing that. We stopped doing that in the 70s. And so we went to globalism, which was a big mistake, right now, Wall Street is still in denial of everything I'm saying. Wall Street still believes that the US is the global economic hub of the world. New York City is the financial hub of the world, and everything is still hunky-dory, everything is fine. The kumbaya is still flying on Wall Street. Say that they're using hopium pills. They got a supply of hopium pills. But once this end of an era starts to manifest and show its face, I think we're really close. As a matter of fact, I think this next recession is going to be the signpost, because I don't think we're going to come out of it. So once we go into this recession and we go into this muddling phase, and that basically our standard of living is going to get stuck, and it's going to start. You're going to have winners and losers, of course. The top 5-10% of America is going to do fine. And, the bottom 50% are going to struggle, and they're starting to struggle now, and it's just going to get worse. And so it's not going to be pretty, but the good thing is we're not going to crash. So,
okay, that really would be you call it the end of an era, but that doesn't happen in isolation. So if we've got the loss of military dominance by the US, the loss of the reserve currency status of the US dollar, and potential default on debt, that doesn't happen in isolation. That has some severe implications for the entire globe.
Right, it does. I believe that the financial hub of the world and the financial strength of the world will move to Asia. And I think it's happening right now, because that's where you have economic growth. That's where you have economic dynamism. I mean, if you look at what China's done with their infrastructure, it's amazing. They passed us up. I mean, if you look at some of the podcasts, they're basically more technological than we are. I mean, they don't carry currency anymore. They use their phones for buying everything. We're not even close to that yet. A lot of their cities are basically brand new. Their airports are brand new, and I think this is going to be somewhat. That's where the strength's going to be. That's where the growth. The U.S. is hitting a wall, and Asia is actually, going upward. So it just shows you that that's where we're shifting to. And China recognizes it. And so China's building this, the One Belt Road. They're trying to connect themselves to Europe. And so if we look at Ukraine is the trigger. So Ukraine is creating this, the end of SWIFT as the dominant economic trade methodology. I think we're going to see some new currencies appear, basket currencies that are used for trade. This is a big, and this is not good for the U.S. If you look at Ukraine, the U.S.'s journalists have done such a poor job on explaining what's really happening in Eastern Europe and NATO. Eurasia, Zebny Brzezinski wrote this fantastic book called The Grand Chessboard. And that guy, I mean, he was brilliant. He understood Asia. He understood the whole dynamics of Asia and Europe. He basically called it, whoever controls Eurasia controls the world. So, and he saw that it was inevitable that Asia, you got Eastern Europe, and then you have Asian countries, all basically becoming one big economic bloc. And he saw this, and he said that the biggest trigger of all of it for Russia was Ukraine. And the US, and it's really interesting because, everybody says that, the US, if they're the odd man out. So if you create this one big economic bloc in Eurasia, and you connect Europe to Asia, and you make it one big bloc, with China right there in the middle of the block, China and Russia and India and Europe, you make that one big block. Where's the U.S.? The only main ally, we left would be for U.S. would be Japan. That's about it. They're totally the odd man out. They're not going to probably lose their connection with Japan. But who else if they get pushed out? So why did the U.S. become so aggressive on NATO expansion when Russia was really not being aggressive? We keep pushing them in a corner, pushing them in a corner, pushing them in a corner. And Brzezinski said this. He said, Ukraine is the vital country for Russian defense. It's like they have to have. They don't have Ukraine. They're completely isolated. There's nobody else. They don't have another ally there to help them. They're all by themselves. So if you surround them completely, and everybody else joins Europe, Russia's all by themselves, and then the U.S. is constantly pointing their weapons at them, calling them the bad guy.
Poking the bear.
According to Brzezinski, if you did this, it's inevitable you're going to have a war, which is what we ended up having. But this is very economic in nature. That's what Brzezinski was kind of showing in his book, that Eurasia is economic. It's an economic grouping that pushes the U.S. out, pushes the U.S. influence out, which the U.S. can't have because the U.S. wants to be the global dominant player. So the journalists around the world, they never talk about the economic implications of NATO and all of this. In many respects, it's kind of philosophical in nature. They don't want to talk about anything that's above eighth grader level. But Ukraine was pivotal. It was totally pivotal, and everybody's saying, it's just Russia wants to expand into Eastern Europe.
But the US is not going to give up military dominance, excuse the pun, without a fight, though. I mean, this isn't necessarily going to be a smooth transition of the balance of power moving from west to east, is it?
Well, it would have been if the U.S. would have basically not expanded NATO. If they wouldn't have expanded NATO, the U.S. would have been marginalized really quickly, because if they wouldn't have done that, Russia would have steadily moved closer and closer to Europe, because they wouldn't have been afraid of anybody in Europe, and they would have worked with China to create this Eurasian economic bloc. But that's water under the bridge. That's hypothetical stuff. That's done with. Now the U.S. has basically accomplished their mission, but it's backfiring on them. It accomplished their mission in that they've made Russia the bad guy, so that NATO can now become very important. So if NATO is important, the U.S. is important, and that was their goal. But now they have to deal with the U.S., their economic policy, which is failing. So it was inevitable that the U.S. empire eventually ended. But by expanding NATO, they just sped it up. They sped it up, in my opinion. And now we're going to see it unfold. And this is pretty historic, what's happening.
Given the massive uncertainty now that has been created because of the war in Ukraine, as you say, three drivers: inflation, Ukraine, and the hangover from the COVID economy, and then you had a couple of others. We've got significant inflation. It's rampant, it's everywhere. And we're still having those overhangs we're still having that hangover from the COVID pandemic. We've seen gold, it reached an all-time high in 2020, and then basically corrected and went sideways, and we're trading 1850 at the moment, thereabouts. Given everything that's gone on in the world, particularly since the Black Swan event of Ukraine starting in February, you would expect to see gold significantly higher. Why has it, in your opinion, stayed so subdued through this? And what is going to be the actual trigger for it to break out to the upside? Is it a slow grind higher, or is it a breakout to the upside, significant breakout we see?
Right. So as far as the trigger goes, I think that's what we've been talking about this entire interview. But the reason why it hasn't broken out is because of the lack of belief of everything we've been talking about. So you have to have a fear of systemic failure in order for the one percenters, the billionaires, the hedge funds, Wall Street, the big money, that's what moves gold higher. It's called the fear trade. So right now they're like, when you have a lot of money floating around, which we do, I mean, the US, they've been printing money at an unbelievable pace. When you have that much money floating around, it creates liquidity. And so the big thing that creates systemic fear, systemic risk, is the lack of liquidity.
Mm-hmm.
So the bond market and the stock market are basically liquidity monsters. They want liquidity. You give them liquidity and they grow. You take away liquidity and they die. So right now, we haven't had a liquidity crisis, right? There hasn't been one. Since 2020, that they basically injected money and prevented a liquidity crisis. March of 2020, we were back on our feet in April. They didn't allow a liquidity crisis. And the reason why is because MMT, the whole purpose of MMT is to not allow a liquidity crisis.
Mm-hmm.
So since we haven't had one, Wall Street is like, we're good. We got the Fed, we got MMT. They're gonna pivot. They're gonna reduce rates. I mean, if you watch the cable news, the cable business channels here in the States, 90% of the people on there are very bullish going forward. They think that this too will pass kind of mentality. They don't have fear. So there's the fear on Wall Street doesn't exist. So that's your driver. We talked about the underlying drivers up until now. And now the ultimate driver is when you get a threshold. The threshold reaches a point where these groups that I just mentioned decide, okay, I need gold. They only do that when they have to. They don't want gold. They have to own gold as protection, as a hedge. It's the only time they go to it, the only time they run to it. They don't run to it to make money. They run to it to basically a place to hide. So this is the ultimate gold trade. And silver is gold on steroids. Silver will always run with gold. It's not going to basically go hide in a corner. And so once we get this sentiment flip, and the sentiment flip is, we got a problem here. There's over $100 trillion in the bond market. There's over $100 trillion in the stock market. It's a lot of money. And if people decide this is not safe anymore, where do they go? It's called Exter's pyramid. Gold is at the very bottom of the pyramid. That's where you go. But you only go there if you have to. You got to be forced there. Now, it happened in 2001. So you came out in 1988, 99. And then in the year 2000, Wall Street, the Wall Street bubble popped. The dot-com bubble popped in 2000. And then right after that, we had a recession in 2001. That combination basically created a fear trade, a systemic fear trade. What's going to happen? And everybody's starting to recognize that. But MMT wasn't accepted yet in the Fed. It was accepted in Japan, but it hadn't been accepted yet. So we didn't know, what MMT could do with the injection of, basically printing money at will. And so we got the fear trade, and it stayed in effect all the way until 2011, and gold went from 250 to 1900 because people were afraid of this systemic fear. And then MMT came along. People go, we're good. We don't have to worry about liquidity issues anymore. And basically we had a growth period from 2011 till now. And so now the fear trade, we had a mini fear trade from March 2020 until August 2020. But then, everybody said, no, don't worry, we're good. We got the Fed's got our back. They're printing like crazy. We don't have to worry about liquidity price problems. So once it's all about liquidity crisis. That's what creates systemic crisis.
Right.
And that's a trigger.
So basically what you're saying is it doesn't really matter what's happening at the moment, but it's the perception of what's happening at the moment that counts. So people are perceiving that everything is still okay, that there is still liquidity. But all of the things that we've talked about, particularly this uncertainty in Ukraine, which has brought everything together now and brought a focus in on it, that eventually that's going to contribute to, in some form, a liquidity crisis. And when we see that liquidity crisis come to the fore, that's when the perception changes. And when that perception changes, that's when we see everybody run to gold and silver.
Yeah, that's a really important point. And I always say that you don't need a systemic failure to have the perception. So the perception can actually occur much earlier. So once you get a perception that we have potential systemic risk, that's when people go to gold. They don't go to gold. They will go to gold, of course, if there is systemic failure. But that's not what you need. To get to $3,000 gold, all we need is perception. We need perception of potential collapse. And once the perception is there, that creates your fear trade. It's like, it could happen. Will it happen? Perfect example. I watched Margin Call last night, the movie.
Great movie, yeah.
Jeremy Irons, he basically said, the music has stopped. Now, it was only perception. The music hadn't stopped yet. He goes, I don't hear the music playing. That is exactly what's going to happen, is people thinking the music has stopped. And if they think it's stopped, they're going to buy gold. And that's basically what happened in that movie.
Now, you mentioned $3,000 gold, but in terms of where do you think things are going to go in the next 12 months? Do you think we're going to reach something like that, or is it something else?
Yeah. This is where, prognosticators are always wrong, trying to
you get put on the spot. Yeah.
They're always wrong every time they try to make it a guess. I try not to go more than 6 months, because if you go more than 6 months, you basically, forget about it. You're going to be wrong. But I'm going to go more than 6 months on this one. So my belief, what I think is going to happen is that we're going to, through the summer, where the stock market is going to go lower, trying to find a bottom. And then once it finds a bottom, it's not going to bounce much. It's basically going to kind of hit a wall, waiting for the Fed to pivot. Now, I think the Fed will raise rates in June and July, and they will pause. So after they make that second raise in July, they're going to pause, and they're going to wait for inflation to see what it does. And they're going to basically be patient. And so Powell is not an aggressive guy. He's not somebody that pulls the trigger quickly. And we've seen that, right? They say he's behind the curve now because he basically wouldn't pull the trigger. So I don't think they're going to pivot in September. I think Powell will be more passive in that respect. He's going to watch inflation to see what it does. I think inflation is going to persist, but not at 10. I think it's at 10% right now. They say it's at like 8. And a lot of people say 10%, it's higher. Food's higher than 10, absolutely. For some people, it's higher than 10, but the average person, I think it's about 10. I think it's, for the average person, I think it's going to stay there through the summer. And then I think it's going to stay above 5% the rest of the year. But those are real numbers. What the government tells us, I think it's going to start to go down a little bit. I do think that inflation is going to peak here in the summer. And so, but it's going to remain high, especially, oil, I think, is going to remain high. Food's going to remain high. Rent's going to remain high. Those things are not going away. Those are your big budget items. So we go through the summer, and I think gold is trapped under that situation, because until the Fed pivots, the dollar is going to remain high, and Wall Street's going to remain bullish that once the pivot happens, the economy is going to kind of roar back here. So Wall Street's not going to give up until after the pivot, after they see the pivot doesn't work. So I think that gold will make a run before the end of the year. Now, a run above 2,000. Now, I don't know how high it'll go. Now, the good news for gold bulls is I think once it gets above 2,000, I think it's going to stay there. I think this is going to be the run. So now, next year, 2023, remember I said you go by in 6 months, you're foolish, right? 2023, I really feel is going to be one of the best years ever for gold, silver, and the miners.
Right.
Because I just think we're going to, once we get over 2000, I think that's really when the sentiment flips and people start to recognize the US is in trouble here. And once that recognition kicks in, like Iron said, the music is stopped. We got a problem here. The leverage in the global economy, in the US economy, is massive. I mean, you have $2 quadrillion in derivatives.
Mm-hmm.
So if the bond market just cracks a little bit, that's where then the bleed comes over from the derivatives. And so that's when you start to get this liquidity issue. So Q3, Q4, in my opinion, that's when the trigger happens. We'll have to wait and see. But through the summer, I think gold's going to be trapped here. I don't see it getting over 1950. And let's look at some of the lows. I think depending on how low the S&P 500 goes. So if it goes down to 3,400 and 3,400 doesn't hold, then gold really is going to get hit here. I think that the HUI, which is around 260, 250s, I think it went below 260 today.
Mm-hmm.
I think it's going to go down somewhere between 220 and 235.
Right.
That's a pretty good range. I'm hoping 235 holds, but I do think we'll go down and retest 235 when we might retest 227, which was the low. But if that happens, silver's probably going to probably go down and test 20, which I didn't really want to see happen.
Mm-hmm.
I don't want to see teens in silver, but it could happen. But as far as I'm concerned, I'm not that worried as long as gold holds, 1680. And it's got a long way down to go to 1680. So 1680 is the bottom of this correction. As long as it holds 1680, it's fine. I think gold could go down to 1725, 1750, but I don't want to see it going below that. But we still have 1680 as a final bottom. Silver's the final bottom is 1850. And so these bottoms, they might not get touched this summer. I think they will. Bitcoin's making I think a dead cat bounce here. I don't think it's going to hold. It's trading well today, but I think once the stock market starts selling off again in June, that Bitcoin will come back down, retest 27, might go down to 25 to 22. So we have selling everywhere here. Inflation is going to stay high for all commodities. Oil is going to go higher. Food's going higher. So it's going to be a brutal summer, but let's wait and see where we're at in September, October.
Brutal summer. On that cheery note, maybe you can tell us a little bit more about goldstockdata.com and what it is that you do there and how people can get in touch with you.
Hey, yeah, thanks for asking. I don't get a chance to explain my website that much. So I started investing in juniors in 2004, and I couldn't find a book. So I wrote my own book in 2010. I had to learn it on my own. And since I couldn't find a book, I wrote a book. Then after I wrote my book, I just said I couldn't find a website that had any data on the gold and silver miners. So that's why it says gold stock, but it's also silver miners as well. Could say gold, silver stock mine data. But what I wanted to provide was for not newbies. I really created it for experienced investors who needed a tool. They needed access. So my database has all the gold and silver miners in the world, has about 900. So it's a huge database that you can access. It's like part of your toolbox. So it's a database, but in tandem with that, it has a lot of valuable information. I have a profile page for every company where I personally have a couple paragraph explanation of what this company does. That's invaluable. Plus, I do future valuations of any company that has resources. That's invaluable. Plus, there's a forum that's invaluable. So there's lots of value that we provide, but it's basically a database of gold and silver mining stock information with additions. But thanks for asking, Dave.
No worries. So it's goldstockdata.com is the URL. Are you active on Twitter?
Yeah. It's I have 20,000 followers on Twitter. I focus mostly on the gold and silver mining stock, but I also do, global events. Can't keep my mouth shut. Yeah. So on Twitter, it's really easy to follow me. Just go there and just search for Don Durrett. You'll find me.
Perfect. Well, what I'll do is I'm going to stick a link to your website and to your Twitter handle in the description and show notes below this video. And hopefully we get a chance to catch up with you again, Don, maybe in the autumn, see how those predictions come through or not. But for now, Don Durrett, thanks for joining us on Gold Core TV today.
All right, Dave, I'll be back.
My thanks to Don for joining us today. And as mentioned, you can get access to his insights through his book and also through his website, goldsilverdata.com. Now, the interview with Don is a good reminder that very often when we spend time looking at financial markets and at the price of investments, it's very easy to get bogged down in what recent events can mean. And we ask ourselves why they aren't having the impact that we expect them to have. Of course, when it comes to gold, and to some extent silver, then we're looking at entirely long-term assets. And so it's the systemic risks, those long-term risks, that are the reasons that we hold precious metals. It's when the sentiment and perception surrounding systemic factors gets weak that we will see gold and silver really come into their own. Now, if you enjoyed this interview, then may we point you in the direction of another great interview with Simon Hunt, who also explores the idea of China-Russia's dominance and the collapse of the US dollar. Thank you for joining us today, and we'll see you next time on Gold Core TV. Don't forget to hit subscribe to be sure that you don't miss any of our conversations with Don and other market-leading experts, commentators, and investors.